And my main bone to pick is that we're selling people investments that really aren't good investments.
Adam Niman.
Niman,
Niman.
everyone gets it wrong.
Screwed this thing up already. All right, cool. Tell me a bit about yourself, what you do, and your story, because you have a super interesting story. We chatted a bit on the phone, I think it was last week. You caught my attention. So yeah, tell me a bit about what you do and your story.
There's a lot of different words, but I just say to people I sell life insurance. I offer financial advice, but all of that is in the context of life insurance.
Okay, so if we could boil it down into just that, it would be Adam Nyman sells
Sells
life.
life insurance. Yeah. I don't
Cool.
want to make it seem more than it is.
Okay, so I guess you have a particular bone to pick.
Yeah.
Tell
Yeah.
me about that.
Every insurance company has two products that they sell, right? The term insurance and the permanent insurance. And it feels like in my industry, there's a constant battle between which one's better and which one's worse. Um, and a lot of it has to do with who your clientele is, and the type of person you are, how much money you have, and kind of what you want. Um, but there's always been, and there specifically is right now, a massive push with regards to these investment grade policies, you know? And if you've ever searched for life insurance or investment grade insurance online, I'm sure it'll pop up in your Facebook or Instagram feed. You'll see things like, the child plan, where RESPs, registered education saving plans, are outdated, buy this instead, or, what doctors and dentists and lawyers do to build tax-free cash, or immediate financing arrangements, or dividends for life, or the be your own banker policy. And I specifically have a bone to pick with these marketing tools because I feel like the product in my industry is just extremely misrepresented. And I found this out not because I started to do research. It kind of happened by accident. Because I was able to buy these old books of policies, I was lucky enough to be able to contact clients who purchased products like this, back in the 60s, 70s, 80s, and 90s. And I think the oldest policy I have in the books right now is from 1967, right? And it's really cool because you can go back and see kind of how history is repeating itself. People are buying similar things. And the pitch kind of stays the same from a theme perspective, but definitely adapts over time. In the 1980s and 90s, it was the vanishing premium. That kind of fell by the wayside because of some lawsuits. And nowadays, it's the be your own banking strategy. The idea that you can buy these participating dividend earning life insurance policies. You can borrow from them. Instead of paying interest to a bank, you're paying it to yourself. You use that leveraging, you're getting 6% on your money for life. And if you die, your family gets the money, and it's just going to keep growing and growing and compounding, and you're going to end up with all this money when you're 60, 70, or 80. And the illustrations are very appealing because you're putting in X dollars a month or X thousands of dollars a year. And the death benefits in the age when you're 50, 60, 70, 80, they get up there, and you can't argue with numbers on a page, so they're easy to sell. The problem is I have a lot of clients who got these products way back in the day, and the values that they see today are just way off compared to what they purchased and what they were made to believe they were buying back 20, 30, 40, 50 years ago.
Are you saying that these life insurance policies that people were purchasing under the pretense of a promise that these insurance companies are not delivering on that promise?
See, it's complicated, right? There's a difference between the question is who isn't delivering, because insurance companies, I've been to a lot of these marketing sessions and continuing education sessions around these products. I think the messaging from the insurance companies have definitely changed, specifically after the litigation in the 90s and early 2000s with regards to how these products were sold before then. There was a time that these products were sold as specifically the dividend participating life insurance policies. It was called the vanishing premium litigation, where you had advisors selling this policy saying, listen, the idea is you pay a little bit more, you have something for life, and there's an investment component to it. So not only are you paying for the insurance, and if you die, your family gets the money, but every year there's ability to participate in the returns of the insurance company, specifically the fund that you're investing in.
But like just the overall gist of it, as if the viewer is a 6-year-old, there is a policy that is being sold to people right now, or a group of policies being sold to people right now that is marketed in a specific way that is not delivering on the promise that they are that they are marketing. Is that the case?
It's more nuanced than that. It's not a matter of them not delivering on the promise. It's just that it's impossible to evaluate whether or not the insurance company can deliver on the promise. So I'm
That's
specifically
interesting.
talking about participating life insurance policies. And a lot of people buy these, and a lot of advisors sell them. There's not a lot of risk in the policy, because the reality is if someone dies, the family gets the money, so it worked, you know? Um, and generally speaking, you need to keep it probably, for what I see in my book, probably a good. It, you start to notice cracks. I got one for my daughter. She's 8 years old. I'm starting to notice a small crack, meaning a difference between what I sold myself in the illustration and then what the reality is in the annual statement I'm getting. It
And
still looks good, but it's a small difference. So I'm interested to see what happens with the ones that I sold to myself and a few clients years ago. But from what I'm seeing from my book, you really only see these differences maybe 25, 30 years down the road. I also think of it kind of like I like space, astronomy. Like if you what NASA did recently trying to knock an asteroid, right? You just push it a little bit and fine, it may be off by inches. But when you extrapolate that over tens of millions of miles, this asteroid could miss the Earth like, distances that we're talking between here and the moon and beyond, even though in the moment it was only a small change that you made. And that's kind of what I see with these products, right? Even though the difference now may be small, I'm looking forward and saying it's possible that difference could be massive when my daughter is 30, 40, or 50 years old. Because I bought this hoping that there would be a massive amount of money here for her when she's in her 50s. Not only she'll have this nice permanent insurance policy, but she'll have this big investment component, right? And that's my concern, that a lot of people are being sold things and they really don't understand exactly where the money's coming from. So what happens when you buy a participating life insurance policy? You're spending, let's say, 100 a month for 100 grand. I'm making up these numbers, but just for sake of, an example here. $50 a month goes to the cost of the insurance because you got to price that risk. If something happens to you tomorrow, the insurance company has to pay out that 100 grand to your beneficiaries. The other 50 a month goes towards the investment component. Now that whole 100 a month premium goes into separate fund. It's called the participating fund. And all the big insurance companies that sell this product, most of them do, have a participating fund. And it kind of operates like a pension. With mutual funds or segregated funds or ETFs, you kind of pick what you want. You want a US equity, or you want a portfolio, or you want something risky or conservative. But with these par funds, they manage it on their own, and they manage it safely, securely, and pretty conservatively. Over time, these funds perform really well, looking at long-term returns similar to the market, minus factoring some management fees. So when you see this illustration and when you see the marketing material they give you, you see, geez, this participating fund has been around since, some of them since the late 1800s, one of them specifically. And every year for the last 30 years have been positive annual returns. And because every year over the last 30 years or 40 years have been positive annual returns, you say to yourself, geez, like there's no reason why this illustration can't look amazing in the future. Look at how consistent these returns are. And even though I had clients where the dividends weren't what they were promised, they were still getting dividends, and there was still some money there and it still grew. Fine, it wasn't what they thought it would be, but listen, it's better than nothing. And I really didn't think anything of it. And I didn't think anything of it because it's not like they were complaining about it. These people just bought this permanent insurance policy because they wanted some life insurance that stayed with them for their whole life. And they had low expectations. Because they had low expectations and they weren't complaining, there was no red flags for me. And then about in 2016, I met with a new client. It was a referral through, I can't remember who, but someone in my book. And I visited her, just bought a new house, was going to have a kid soon, wanted some term insurance. It was an easy sale for me. And while I was at her house, she mentioned how she had this old investment policy with a loan on it, you know? And she showed me the statement, and it was one of these whole life these participating life policies that she got, that I think her grandfather got for her in 1979 when she was just born. And there was a loan outstanding on it. Um, and the loan interest rate was higher than if she were to put it on a line of credit. So I said, listen, you should just refinance the loan on your policy and pay it off with your home equity line of credit. That's, saving 1.5% spread. That's free found money. So she had a line of credit through her house, paid off the loan, and that was it. I made a nice sale. But the nice part about taking over her policy is now I'm the advisor of record, and now I get her statements. And that summer, I think her year is in June. So June of that year, I get her annual statement and I see like no dividend. And I'm like, I just was kind of floored. I'm like, what the hell? Like, how is this possible? I've never seen a policy with no dividend, especially because this same company, I was at their event maybe a week or so earlier. And I remember this, they said it verbatim. We've paid a dividend every year for the last 110 years. Like, that's pretty emphatic. Like, if you're an advisor and if you're selling someone's policy, specifically an investment grade dividend producing policy, and they say to you, Adam, we've paid out a dividend every year for the last 110 years, I'd be like, holy shit, like, this is great. I can sell this to my clients and I'm confident that they're going to get dividends for their entire life because they've been doing this for so long and every year they've paid out a dividend. So I was kind of surprised by this. I sent an email to the insurance company and they basically said, listen, a lot has changed since 1979. Interest rates were high then, they're low now. Sorry. And I really didn't think anything of the response. My client wasn't complaining about it. I thought it was surprising, but it was just 1 year. Next year, annual statement again, no dividend. I'm like, what's going on? And I sent an email, and what was interesting was the reply that I got from a different individual at the company was word for word the same. Like they copied and pasted the same response from the year earlier, which meant no one was actually kind of explaining what was going on to me. They just had this response that they would send out if people kind of questioned what was going on. So through calls, meetings, reading a bunch, and going down this rabbit hole, basically what I was able to find out, which is in the marketing material, but people really don't think of it enough, is that people think that they're paid dividends based on the performance of the fund, or sometimes people have pitched the performance of the insurance company itself. But how it works is that when you buy the policy, there's specific guarantees. Like there's a guaranteed cash value. So no matter what, there's going to be a floor there. And the dividends that you see, so when you have that illustration, you see an annual dividend, and you see what the death benefit's going to be when you're 20, 50, 60, 80, 100, that's based on a set of underlying assumptions. The assumptions are based on variables, which are returns. Returns are a big one. Mortality, how many people cancel a policy, how many people borrow against it, how many people just walk away from the policy. The insurance company creates a set of assumptions, and you're paid dividends based on how closely reality is to those assumptions. So imagine an advisor sitting down with you saying, Adam, I want you to buy this stock. And you say, why? And you're saying, well, I believe it's going to go up in price, right? I believe, you're going to buy it at $5. It's going to go to $10. But you're not paid based on how the price of the stock moved. You're going to get returns based on how well I predict the stock is going to move. So if I predict the stock from move to 5 to 7, you'll get this amount. But if I predicted it to go from 5 to 10, right, and it goes from 5 to 9, you're not going to get anything because I didn't make proper predictions. And the reality is that's what's happening here. The insurance companies are making assumptions, paying you dividends based on how closely those assumptions align to reality. And if they don't, then you stop getting dividends. And the problem is you're not told what these assumptions are. So for my client's policy, they're saying, well, back when you purchased this policy in 1979, interest rates were significantly higher, and they're not now. And your policy and the group of your policies that were purchased together aren't profitable enough for the underlying block and aren't profitable enough for us to pay dividends. Meanwhile, they also say that the longer a policy is in force, the more the investments matter. And I say to myself, well, hold on a second. you just throw a dart at any asset class in 1979. If you held on to it today, you'd be significantly better off. You'd have a lot of money. So my problem with the product is that in reality, it's just impossible to evaluate one company to another. It's impossible to know how realistic the numbers you see are on that illustration simply because they're not telling you what variables or what assumptions are made for your policy. And the reality is no insurance company will disclose this to you.
I can hear the comment section already where, people are like, you know,
Why does this matter?
wow, shocking.
Yeah.
An insurance company is they're slimy, right?
Yeah,
Like,
it's not that simple though, but I know
so
what you mean.
yeah, but it's not really like why should we care? It's more of what is the difference between the obligations to disclose from any other hedge fund money management company to disclose exactly what they're doing with the money and any insurance company and what they're doing with the money? Is there a difference?
There is the Ontario OFSI, Ontario Financial. I can't remember what all these acronyms, but OFSI did publish disclosure requirements in 2011 that basically says what insurance companies should do in the context of disclosure and managing these par funds and what they should say to people. Based on my reading of that document, it says that you should be as transparent as possible. People have a right to know. People have a right to know context. Err on the side of inclusion. That's a line in the document. Like if you're not sure whether or not to disclose something, it's best to just disclose it. The problem is though, there's so many regulatory bodies. These insurance companies have so much money. They obviously have a part in writing the legislation because you need people who understand the industry, you know, to help people who don't understand the industry to write this legislation. And the reality is the insurance companies disclose everything with regards to how the money is managed inside the par fund. Like you could download these reports. They're massive. You can see every holding, how much money they make on all these holdings and whatnot. But the problem is that how well the fund does is not at all relevant. All that matters to you as a policyholder is what they predicted for you when you purchased it. Now, one thing I do know is that a rising interest rate environment is good for insurance companies, is good for these products. And a lot of these companies, from an old underwriter and actuary that I spoke with who used to manage the product, said that most insurance companies, if not all that he's spoken to, are predicting rising interest rates. So because of what's going on out there, it's very possible that the people buying these policies today may actually have a better 30, 40, 50 a year horizon than the clients that I have that I see who bought this in the 70s or the 80s. The problem is, there's no way to know because they're not going to tell you what they're assuming for your policy. And it's concerning that they can just decide, the insurance company can just decide that, you know what, your policy that you bought with these people in your age group and similar health, you guys are profitable enough, so we're not going to give you a dividend. And one of the chief actuaries at a major company that I was arguing with about this, I'm trying to get him to do an interview, but he refused, and I get why. He said to me, he's like, listen, if you buy CIBC stock or ABC Co., you have no control over the dividend they issue. Like none, right? They could decide not to issue a dividend, and there's nothing you could do about it. And he's right, but the only problem is if they do issue one, I know where I am in the pecking order. Like if you have 100 shares and they're issuing you, a buck a share, I know exactly what I'm getting. So even if when they do declare that one's being issued, I know exactly where it comes from and I know exactly how much I'm getting. The problem is with these products is, I see I'm getting a dividend, but I don't know what the source of that is. They say, Adam, we're going to pay you this year a dividend scale interest rate is 6%. 6% of what? Like, what are the assumptions? Like, where is this money coming from? Your fund returned 8% this year. Great. Like, you gave me a check for $220 that I put back into the policy. Like, what is that $220 made up of? Like, they really don't share that. That's proprietary info. No insurance company will share it. And the issue isn't that the insurance companies aren't disclosing enough. The issue is that because they're not disclosing enough, it allows the marketplace to create a narrative in and around these products and offer it to people and sell it to people that it's probably not a fit for. And my main bone to pick is that we're selling people investments that really aren't good investments. These products are great for people with leftover cash flow, a lot of non-registered cash, extra money saying, I don't know what to do with, I pay all this tax. And for a lot of those people, might as well pay insurance premiums over tax because your family gets more money when you pass away. And when I go to these insurance company events, they're very clear that these products are designed for like the higher net worth individuals. But because there's not enough clarity and around the disclosure, a lot of these products are being marketed to the lower end of the market, people who don't have a lot of investments. And you're shown illustrations that make it look like you'll be a millionaire in your 60s and 70s. And to be honest, A, there's no way to evaluate whether or not that will be the case. And B, based on what's happened historically, I don't think that actually will be the case because, if you look what happened in the 70s and 80s, the people who bought those then aren't happy now. And I think history is just going to repeat itself again. But listen, it's easy to sell something and fuck up in 30 years because, like, who knows if I'll be in the industry 30 years? Everyone in and around that sale's gone. So much time has passed. Not to mention, if the policyholder dies, the family gets the money. And when the family gets the money, it's not like they look, what did dad buy 40 years ago? Is this what it's supposed to be worth? Someone passed away, they get the money, and that's it. So it's really easy for I don't want it's not a fraud. It's really easy for this to continue because it's so subtle and it's nuanced. And
So, Adam, forgive me, but you can't be the only one who has discovered this, right? Like how much how much pushback has there been in an organized fashion against this kind of thing? Or is it just that, like you're saying, these things are scaled out over so many years that there are just very few people that are looking under the hood?
I think that's it. I think too, there are very few people who are getting zero dividends. Like that's rare. When I mention this to other advisors, they're like, I don't believe it, right? Even older guys who've been around for years, right? They understand this stuff a little bit, but they still sometimes have a hard time believing that I have a client who's not getting a dividend like at all. Most older guys in my industry, and I've heard this from people, they call this product a black box. And a lot of people who've been around for a long time don't sell this just because they sold it when they were younger. It doesn't look good today, and I'm not going to make the same mistake twice.
So is this more, I mean, in my mind, when I'm hearing this and I'm hearing the explanation around this, this sounds a lot more like incompetence than it does sound like malicious intent.
100%. It's definitely not malicious. Like advisors who are selling this today, like genuinely believe in what they're selling, and they genuinely believe in it because um, they're kind of told to believe in it in
And
a way.
and in terms of the marketing that insurance companies are doing towards this as well, is that also incompetence?
No, no, insurance companies don't market this product to the public. Insurance companies market this product to advisors. And they are aware of the problems that have happened to it in the past. And they're saying that, there is more disclosure. There is slightly more transparency. And when I say slightly, simply because until you tell people what the assumptions are underlying what they bought, I don't think they're being transparent enough. But the one thing the insurance companies are doing very well at these days is being clear about who these products are designed for and who they're a best fit for. I was in an industry event 2 weeks ago, and the person pitching this product for the company basically said that this is for small business owners, ideally, who net out over half a million a year in their small business. Like, so after your expenses, after you drew a salary, you're exceeding the small business exemption. Like, how many people do you know that after everything are still like, fuck, Adam, I have a $500,000 left in my corporation at the end of the year. I don't know what to do with it. Like, that's rare. Like, that's extremely rare. Even for people who are super high net worth, I still don't know anyone who at the end of every year is like, another 500,000. I don't know what to do with. Oh, got to pay more tax. I can't draw any more salary. Can't draw any more dividends. My RSPs are maxed out. TFSA is maxed out. I have all my write-offs. I don't know what to do with this $500,000. That's kind of what he was suggesting. But the reality is, the majority of people buying this product is someone who said, you know what, I want to invest for my child because the RESP is outdated and I want them to be a millionaire when they're 60s. Or someone, a good example of how this is being bastardized is the be your own banker concept, where the idea is you buy this policy and you use the dividend growth and the cash value as security for a loan. And the reason why you use it as security for a loan is because when you borrow from your policy, you're actually borrowing from yourself and you get to recapture the interest. Okay.
Sorry,
It's
yeah.
all good,
I
man.
just took in a bit of coffee the wrong way.
Yeah, so basically, listen, the insurance companies aren't telling enough and are basically letting the advisors kind of market it like they want. And that's why you see the product marketed in so many different ways. And I blame the insurance companies for not being more clear and specific. But at the end of the day, the advisors are kind of taking these concepts and running it with it. You throw in TikTok and Instagram into the mix where you can flash up some numbers quickly, make it seem, in 30 or 40 years how great something will look. The problem is a lot of the people pushing this product these days are young. I wouldn't be surprised if they don't have clients who got these 20 or 30, 40 years ago. They don't see the type of shit that some of these clients are dealing with. So they're just kind of believing the Kool-Aid. They're believing what they're being told, and that in 30, 40, 50 years from now, there will be, continue to get dividends for life. And when you have insurance companies saying, we've paid dividend every year for the last 110 years, it's clear to know that just because a company has paid a dividend every year for the last 110 years doesn't mean everyone has gotten a dividend every year for the last 110 years. And insurance companies dress the product up really well. During the meetings, they do a good job of being specific in who it's for. But at the end of the day, as a salesperson, you want to make money.
So,
And
so, so what you're trying to say, at least what I'm gathering, is that most of the products that you guys sell in your industry are pretty good products.
yeah,
There are just there are a few landmines out there that, you know, you don't want to be somebody who is basically getting screwed, who did the wrong thing, listened to the wrong person, bought the wrong thing, and now years down the line, you're you're not even able to determine because you're oblivious to what the promises were.
yeah, exactly. And the advisors like can't tell you either. If you're seeing an illustration that says when you're 65, this policy is going to be worth $1 million. Like how? Like why? Where is that money's coming from? Like what are the assumptions? What needs to happen for this to be worth $1 million?
And there are no laws that require them to disclose this.
There are, but they're not being abided by, I believe. Um, I've pushed the regulators there, but I'm just one guy selling simple shit. Like, who am I? I'm writing this article. I have a chip on my shoulder about it because I have a lot of clients reach out to me that they want to buy into this concept of be your own banker and they want dividends for life. And I had dreams of like blowing a whistle. I don't want to do that. Like, I don't want to shit on the insurance companies because, like, I genuinely believe in the products that they sell, the vast majority of products that they sell. And like no one's out there to screw anyone at all. And I want to be clear on that. I just have a problem with this little piece. And that's why instead of, trying to blow a whistle on something that is so subtle, you know what? I just want to use this as a way to, drive business for my own business. People should buy insurance for risk. Like I'm spending $327 a month. So if something happens to me, my wife gets 6 million bucks. Like that's insurance. I'm spending $160 a month that if I can't work, I get 5,000 a month tax free to age 65.
So, okay.
That's insurance, not you're going to be earning dividends for life, not you're going to die and leave your kids $1 million at the age of 80 because you're buying this dividend policy. That may happen, that may not happen. Sadly, it's impossible to know. But I want to bring insurance back kind of to its roots. Like cover yourself off for the worst shit that could happen in your life.
So here, and this is the issue that I've always had with your industry, is that, when someone's gonna go buy real estate, it's an open and transparent marketplace. Anybody can go online. You don't even need a realtor. You can just go online and you can see exactly what is for sale. You can see all of the information. You can see where it's located. You can see what the stats are. You can see, does it have 3 bedrooms? Does it have 4, right? You can see pictures. There is transparency into that
It
marketplace.
almost makes me anxious for you guys. I'm just like, holy shit, can you like I'm thinking to myself, fuck, if I was starting out in real estate and pick that, you just see how much data there is out there. It's almost overwhelming. You're like, how do I find a place for myself if people can just go online and not even need me, you know?
honestly, there are a lot of people that shouldn't be in the industry because, well, I mean, that's a whole nother discussion.
Yeah, totally.
But my point being that at the end of the day, the the marketplace for real estate is open and transparent. For what you sell, there is zero transparency. Unless I'm talking to you, I'm not going to hear about the different perspectives on the different products because it's not just the products, it's the perspective on the product
Yeah,
too. Because, you know, what you're selling is an intangible.
100%.
Right.
It's a promise to pay.
Right.
Yeah.
And so when I'm buying peace of mind, which is essentially what you're selling me, um, I actually don't know what products for peace of mind are being offered, and I don't know what the different perspectives are on those products. So, like you have a much more difficult job than I do in that sense. So,
You'd think so, right? But listen, I'm lucky that I was able to start with a block of clients, did a good job with them, and the referrals kind of rolled in. And a lot of the life insurance I sold was like for 10 years and 20 years. I've been in this business now for basically 14 or 15 years. So not only do I have new clients that I deal with now, but all those clients who had products for 10 years, they're coming up and I got to go back to them. And then all the clients that I signed up for 20 years, it's coming up that I have to go back to them as well. So I'm lucky enough that my business is starting to turn over, you know? Um, so that's why it's kind of easy for me right now. And that's why it's been hard for me to, do all this marketing stuff because, day to day I'm reasonably busy and I have a good flow with what I have. But
you don't
you're
seem
entirely right.
you don't seem like a crusader to me.
It's hard to, man, right? Especially because I don't want to like create enemies, especially with people that I believe like are genuinely trying
Are you
to
fear
do a good job.
are you fearful that insurance companies would blackball you?
Dude, the lady who runs my MGA, like she she kind of scares me like into not poking the bear. The reality is I can't remember who it was. It was Joe Rogan's podcast and he had someone on there and the guy said, "If you want to know who your master is, ask yourself who you can't criticize." And that's the insurance companies are my master. I sell their products. They allow me to sell their products. And I'm worried that if I say too much of the wrong thing, they can just cancel my contract. No, Adam, we don't want your business anymore. And it's very easy for them to do that. And that's why I really need to be careful with how I talk about this because like they're not trying to scam people. They're not bad. Like what they do is fucking important and it's good and it's complicated and I want to focus on that and just producing content saying this person's trying to scam you, this person's trying to scam you. um, I don't believe that to be true, and B, I'm worried that if I don't control the messaging, the insurance companies are going to be like, well, this guy's too much of a liability, he'll cut his contract. I don't know how true that is. That's the messaging I get from the people around me, um, and that's kind of why I'm kind of scared to do this.
Well, that's not the messaging that I'm receiving. And this is why I enjoy a lot of this long form content is because you can have a nuanced message
Yeah,
without having the sound bites. Mind you, I am going to take part of what you say and make it into a reel to pull people over to the actual long form content so
right.
they can get a
Yeah,
better idea.
100%.
But having said that, you know, you're not giving me the message of, everyone's trying to scam you. At least that's not what I'm
No,
receiving. I'm receiving a nuanced message from you of not every policy is what they promise, not every and it's not because they're meaning to scam you, it's because the people selling it don't actually know.
totally. I want to be very specific though. The one area that the insurance companies aren't transparent on and should be are the assumptions underlying your policy. It's it's a black box. People in the industry call it a black box. You don't know what you're going to get.
Hold on, they call it is in your industry referred to as a black box?
The older advisors have been around, yes. In fact, one of the head actuaries for one of the major insurers called it this, basically saying if you want transparency, this is not for your clients. And a year before the pandemic, he said, I remember he was standing up in front of the room. we are betting interest rates to go up, and if interest rates go down, you're all fucked. And what he meant by that is that the dividends that you're promised just aren't going to happen. Insurance companies are predicting interest rates to increase. So it's very possible that people buying it now are significantly better off than people who were buying it 20 or 30 years ago. But I don't know. Listen, what goes up must come down. There's a lot of debt out there. I wouldn't bet on, you know, interest rates continuing to climb simply because my belief is governments need to reinforce their own existence. Status quo and maintaining status quo in society as it is of the utmost importance. And the second there's cracks in the economy, they're going to need to kind of settle things down. And in the long run, I just believe interest rates have to go down just because that's what has been happening generationally, you know?
So, is it your belief that government intervention is the answer to this
No,
problem?
no, because I don't believe in too much government. I think that's part of the problem. I think it's important for people to tell these stories. I think it's important for advisors to look at the products that some of their older clients have, compare what they bought to what they had, understand that these are questions that should be asked. And until the insurance companies provide more, sell them something different. There's a lot of investment grade insurance policies that you can get that would give you the transparency that you want. Universal life. Your insurance costs 100 a month. Here, pay 100 a month. You want to invest? Here's 100 a month. Here's your list of funds: U.S. equity indexes, managed funds, index-linked funds, cash funds, bond funds. You sit down with your bank, you're putting RSPs with them. They give you a list of 50 or so funds you can choose from. You can pick portfolios. You can pick specific funds. You know, insurance companies have like science and technology indexes. Super specific stuff. You can still get permanent insurance and great permanent insurance and get all those tax advantages investing with all the transparency that you want. And in my opinion, if more advisors pushed people towards the transparent products, eventually the insurance companies would have to come around. Why? Because at the end of the day, they're responding to the clientele, right? If they know people are demanding more transparency for something, I think they'll give it up. I don't think you need these government organizations, right, that just eat boatloads of money, that work behind the scenes to create change that in reality, the market could do on its own.
So, the forces of the free market to demand from a consumer level more transparency is what you think will create more
That's the way to go, and I think that's the most honest way to go about it. I don't want to battle these companies. I don't want to battle other advisors. You know what I mean? Like, at the end of the day, the most important thing is that when someone gets sick or someone dies, the money's there. And that's going to be true across the board, you know? I just think the best way to go about it is not even say demand. As long as advisors know that at 0% dividend is possible, as long as the consumer knows that that's possible, as long as they know that, listen, you're not paid based on the returns, you're paid based on things they can't share, you're just not going to choose to buy that product. And I think that'll force insurance companies over time to differentiate themselves.
So you're saying that's fine, market to us, but put an asterisk there. Give us an understanding that none of this is guaranteed.
They do. The insurance companies do. They say dividends aren't guaranteed, right? In there, it's very clear. Um, and in their marketing material, they specifically say this is assumptions.
So then what's the problem?
The way it's being sold online now. I don't think people think that these numbers that they're seeing on the illustration are guaranteed. Pretty much. Fine, maybe not 100% of it, but it's going to be pretty close. It's impossible to know. And there are too many young people buying into this product. Why is it that I have clients calling me? They have no TFSAs, they have no RSPs. They don't make a lot of money, and they want to be their own banker. They want a child investment policy. They want a tax-free policy for their business, right? They want this investment grade policy for their dad. Like, if these are the type of people that are calling me about this product, it's being marketed to the wrong person. And I don't want someone putting $300, $400, $500 a month into something for 30 years to look at it in 30 years from now and being like, holy shit, I should have bought a house. I should have bought Apple stock, right? I should have done anything but buy this. And that's my problem. We're too many people are buying it who it's not for. They should use their money and buy actual insurance, term insurance,
Now,
ideally,
now I mean, I've often felt like your industry is kind of almost like in the Stone Ages with a lot of things. Like I feel like just insurance is just so I mean, like slow to adopt everything and anything.
Mhm.
And uh, and one of the things that I've often thought about is that the maturation periods are too long for any kind of scrutiny after speaking to you for this to ever really change. Do you think that that's the case?
Yeah. Yeah, especially because if someone bought this a few weeks ago or like 2 years ago and they see I was supposed to get a $2,000 dividend this year and they got a $2,000 dividend this year, they'll be like, ah, fuck this guy. That's bullshit. And fine, instead, let's say it's not 2,000, it's $1,990. It's only $10 off. It's $10 off.
Right,
It's
but
not a big deal.
scale it over decades.
Scale it over decades, yeah. And just by principle, let's say I'm wrong. Let's say because interest rates are going up in 30 or 40 years, what you were promised $1 million based on the current dividends. Fuck, it's going to be worth 2, 3 million bucks, let's say, or more. That still doesn't excuse the
Yeah.
fact that like they should be more transparent with this stuff. The biggest five insurance companies in our country manage over almost $100 billion in assets in these participating funds. Hoop Healthcare of Ontario pension plan, right? That's worth 140 billion. The teachers, $250 billion. Like the amount of money that the insurance company manage on behalf of Canadians inside these products and inside these funds is absolutely massive, right? And I think Canadians deserve to know exactly where their money's coming from and how they're paid. It just makes rational sense to me. And I think that's my problem with it. It's just not clear enough, and people don't even realize how many people have these products. And the reason why so many people have these products is because the same thing is marketed in so many different ways.
So, Adam, build me a steelman argument against your position. Like
Cool.
what would that look like?
Well, it's great to buy term insurance, but chances are you're gonna not die in 10 years. You're not gonna die in 20 years. You're not gonna die in 30 years. Chances are you're gonna live to age 85 and 90. And if you wait to get permanent insurance, it's too expensive. So you got to get it while you're young, and you want the death benefit to be there when you're old, because the vast majority of insurance policies will never pay because they expire. And when they expire, that's just gone money. The money's lost. I'm spending $327 a month for the next 20 years. I'm probably not going to die before the age of 56, and that is gone. The money's gone. There was no benefit to having it over the 20-year period. The only benefit to having it is that even if my health changes, I can switch it to permanent policy without doing a medical, right? But then I'm in my late 50s. Who knows what the rates are going to be? Who knows how expensive it's going to be? This is why you need permanent insurance. And that's why I have permanent insurance in addition to my term insurance, you know? So as I said, I do believe there's value there, and that's why it's nuanced. I'm just saying that if you're going to buy a permanent insurance policy, do one that's transparent. Don't do this one, right? And understand that it's an insurance policy. Don't confuse it with investing. Investing is buying a house. Investing is buying stocks. Investing is learning how to leverage. Investing is buying something and holding it for 20 or 30 years and gaining that appreciation. These insurance policies, you're paying into them, right? It's not a good investment. Keep that in mind. Focus on it being there for your family when you die. Don't have high expectations of utilizing it in some complicated way while you're alive, because that's not the intent of the product. And let's not make it the intent of the product. That's my point.
Wow. Well, this was super enlightening.
Thanks, man. I
I'm I'm
enjoyed it.
I'm really glad you came by. We should probably end it there because I'm gonna have a nightmare editing and
Yeah,
putting
sorry,
this all
dude.
together because this is gonna take me a long time. But thank you so much for coming in, and we should do this again soon.
Yeah, man. Thanks, dude. I appreciate it, huh?
If you like that video, click the subscribe button on the right, or feel free to enjoy another video here on the left.